Joining us now, Ed Yardeni, president of Yardeni Research. What a year.
What a year.
We can start looking back at it. All of the Liberation Day angst turned into a buying opportunity.
Did indeed.
Obviously. We hear this is the worst economy that the world has ever seen, although the stock market keeps hitting new highs.
Correct.
So I don't...
Well, I mean, we've had the most widely anticipated recession of all times. This didn't happen. I mean, how many years has it been now?
Yep.
And the economy's proven its resilience, and I think it'll continue to do so.
So we're just below 6,900. Dom Chu was just talking about the records of a lot of Wall Street prognosticators. You started the year, I think, at 7,000.
Yeah, then I got whipsawed around with the tariffs.
But you quickly jump back to 7,000?
Yeah. Yeah.
We may not hit 7. We may. We may hit 6,900 today at this point.
Yeah, I mean, it could happen in a couple of days.
Right.
We're basically there.
7,000, a lot better forecast.
I'm going to declare mission accomplished.
Yeah. Oh, good. It's a lot better than a 5,800 forecast, which some individuals, obviously. We just had a technical analyst on, Chris Verone, who was talking technically about why he's seeing did you see him? Because fundamentally you're talking about the same things in terms of a rotation away from some of the speculative sectors to real economy stuff.
To the real economy stuff. Well, I think the Magnificent Seven, I think I previously made an analogy with the Game of Thrones, where they, 7 independent kingdoms, they had their moats around them, and they were happy, prospering with their unique businesses. But AI has kind of forced them to compete with one another, and so it's become a much more competitive game, and I think that is going to start to narrow some of their profit margins and get people to understand that the real beneficiaries of AI are going to be what I call the impressive 493.
Causing you to actually make a change in a... We're not going to be able to watch your performance on a 15-year basis. That's asking to. Maybe we can. I plan on it. Actually, what will I be? Yeah, when we're looking back.
Yeah,
But you actually, and Becky made note of that how significant it was that you had been overweight tech, but it's so overweight now. It's hard to get. It's hard to get more overweight than it already is.
Well, if you take information technology and communication services in the S&P 500. They're 45% of the market cap of the entire index. And so if you tell people overweight that, what are you telling them, like 50, 55, 60? I mean, that's not even close to what their impact is in the overall economy.
Right.
And the real beneficiaries are going to be everybody else that uses AI and whatever other technologies they come up with.
I also thought it was interesting that you said that lower interest rates don't necessarily help a weakening labor market.
Right.
So if what you're saying is correct about the economy, you agree with, we just talked about the Cleveland Fed president. You don't think we need any additional rate
I don't
cuts?
think so, but if the Fed has this notion that we have to get to 3% sometime in the foreseeable future, then I think a lot of that liquidity, a lot of that stimulus will go into financial assets and precious metals. I mean, I've been talking about since the beginning of the year, been talking about getting to 4,000 on the price of gold. It was 3,000 at the beginning of the year. I thought 4,000 by the end of the year, and here we are at 4,500. I thought 5,000 by the end of next year. Now I'm thinking maybe I'm going to have to raise that number, and I'm still thinking 10,000 by the end of the decade, which is actually when I also think the S&P will get to that level. So 10,000 for both by the end of the decade.
That's interesting. You also point out, I was wondering if the corollary is true. If lower yields don't help with a weak labor market, does raising rates always help with inflation? Is that the way to cure inflation?
Well,
that's all they got.
I don't think we have much of an inflation problem. I think if it wasn't for the tariffs, inflation would be down to 2% by now. And
you think so?
Well, I know so based on the CPI. The CPI is the durable goods inflation rate that has come up from -4% to +1% over the past year, and a lot of that was because of the tariffs. But that's I do think it's a transitory thing, and I think productivity is going to bring inflation down to 2%.
If you were advising the Trump administration, would you tell them to hold firm? Because you see how they're reeling from the affordability issue. Is it all for naught? If it would be at 2%? But you know what? Even if we were at 2%, people in the country would still feel
Yeah, that's true.
like they don't have enough money because of the
That's
22%
true.
under the Biden
Yeah.
administration.
Well, I think, when you look at, for example, insurance in New York State for just one young person in their 20s, it's like $4,000 a year. I mean, it's insane, some of these prices levels. And so clearly this is having a depressing impact on some consumers, particularly younger consumers. But on the other hand, you've got the baby boomers who are retiring with $80 trillion of net worth, so they continue to spend. And I think they're actually helping some of their younger kids with mortgages and so on.
So 10,000 by the end of the decade.
2029, yeah.
No, by 2029.
Yeah.
So that's not the if you compound that 26, 27, 28,
Yeah, it's
those
not
are
crazy.
What is it? 7% a
Yeah,
year or something?
yeah. I mean, it's just an extrapolation. Really,
So what
of
next year do you have when do you put out a year-end target for the S&P?
for next year?
Yeah.
7,700. So it's a 10% increase, which would be the fourth.
7,700.
Yeah, that would be the fourth year in a row of double-digit gains, which has happened before. It's not that unusual.
We had those three in when was it? In the 90s, we had 30% plus for 3 years.
Yeah, correct.
That
Yeah.
we're not going to do.
Yeah.
But 4 straight years of double digits.
I think, let's we don't want to do too much. If we do too much, we're talking about a melt up and a meltdown scenario. And I don't think we're going to.
And what do you consider real economy stocks? What sectors?
Well, I think, I've been, I continue to recommend overweighting financials. They work very well. I think they do well with an economy that's solid. I'm not that concerned about things blowing up in the capital markets and the credit markets. I think if we have some private credit loans.
It's on your radar screen, though, isn't it? Private credit.
Yeah, it's on everybody's radar screen. I mean,
cockroaches. Jamie Dimon called it. So.
Cockroaches, yeah, but Jamie Dimon's.
He's got to work. Yeah.
He's been a pessimist for a while, and he's been cautious. He's a banker.
Yeah.
Which is a reasonable thing for him to say. It is something we should be watching out for, but I don't think it's going to be a problem. And so, I think industrials clearly are a real economy sector, and we still have a lot of money being spent on building manufacturing facilities. I don't know what the actual number is of trillions that will be brought over by Trump's negotiations on tariffs, but that's going to be an important factor.